Welcome to Wealth Path. We're glad to be with you on this journey to grow wealth and achieve financial freedom together. With the election coming, in this video we're breaking down how the stock market might react depending on who wins the election. We'll use historical data from past election years, and then predict the impact of Harris and Trump's policies on different sectors. If you haven't subscribed to our channel, you may want to do it now by hitting the subscribe button below and check out our other videos as well. We're posting tons of research-based content about finance and investment. We are here to help you make informed decisions on your path to financial independence. Now on to Part 1, Historical Post-Election Stock Market Performance. First, let's look at the historical data from 1972 to 2020 for the S&P 500, NASDAQ, and Dow Jones after the election day, for 1 month short-term sentiment and longer-term 6-month performance. For 1 month sentiment, we compared the December 1st price to the November 1st price, and for the 6-month longer-term performance after the election day, we compared the May 1st price of the following year with the November 1st price right before the election day. The 1970s were a challenging decade for the stock market, marked by high inflation, rising oil prices, and economic stagnation. This period, often referred to as stagflation, combined stagnant economic growth with high inflation and unemployment, which weighed heavily on market performance. After Nixon's re-election in November 1972, the stock market initially reacted positively, with moderate gain. However, this initial optimism quickly turned sour in 1973. Early in the year, the OPEC oil embargo triggered an energy crisis, sending oil prices skyrocketing and contributing to high inflation. The result was the 1973-1974 bear market, one of the steepest market downturns in history, with the S&P 500 losing nearly 48% of its value. This period of stagflation continued through much of the mid-1970s, leading to severe economic challenges and low market returns. After 1976 Carter's victory, the stock market also gained immediately. But inflation and economic stagnation continued. The 1979 second oil shock exacerbated inflationary pressures, leading the Federal Reserve to implement aggressive interest rate hikes in an attempt to control inflation. These conditions kept the market volatile and largely stagnant, setting the stage for significant economic reforms in the early 1980s under Reagan. The 1980s and 1990s marked a period of substantial growth, innovation, and market expansion. The bull market began with Reagan's policies, continued through strong economic fundamentals, and peaked in the late 1990s with the dot-com boom. These 2 decades set the foundation for modern financial markets, with technological innovation and globalization transforming industries and shaping the market's future. The 2000 election itself, with a contested outcome between George W. Bush and Al Gore, created short-term market uncertainty. After the 2000 election, the U.S. stock market faced significant challenges as it entered a period of volatility and downturns marked by the bursting of the dot-com bubble, the 9/11 attacks, and subsequent economic recession. Between 2000 and 2002, the NASDAQ fell almost 78%, and the S&P 500 and Dow Jones also experienced significant losses. Fast forward to the most recent election, the 2020 election, where Joe Biden defeated Donald Trump. The post-election period saw robust market growth, underpinned by recovery optimism, stimulus, and the gradual reopening of the economy. This period highlighted the market's resilience and quick recovery amid unprecedented global challenges. Overall, for both short-term sentiment and longer-term performance, 80% of the time, among the 13 elections between 1972 and 2020, the 1-month and 6-month post-election performances were positive. On average, 1-month gains after the election day ranged from 1% to 1.5%, while 6-month cumulative gains were between 5% and 8% across the 3 major indexes. To put this into perspective, this is slightly higher than the general monthly averages of 0.6% to 0.9% and 6-month averages of 3% to 6% for the major indexes. However, keep in mind that events like presidential elections can increase stock market volatility, so it's important not to base investment decisions on this single factor alone. Now, let's move on to Part 2. The policies of the 2 candidates and how they may impact stock market. First, Kamala Harris. Her potential policies, which emphasizes clean energy, healthcare, and tax changes, could drive unique impacts across different sectors. Clean energy and environmental policies. One major area Harris is likely to focus on is clean energy and climate action. Building on the Biden administration's priorities, a Harris administration would likely increase investments in renewable energy, aiming for greater infrastructure and support for electric vehicles and sustainable technology. This would likely boost stocks in green energy sectors, like solar, wind, and EV manufacturing. The U.S. renewable energy sector has grown steadily under climate-friendly policies, and an administration prioritizing clean energy could accelerate this growth. Companies like Tesla, NextEra Energy, and First Solar might see increased demand, benefiting from policy incentives designed to promote renewable energy. Next, healthcare expansion. Harris' stance on healthcare is another key factor. She has shown support for expanding healthcare access and affordability, which could lead to more funding for healthcare services, Medicare, and public health initiatives. This would benefit pharmaceutical companies, biotech firms, and digital healthcare providers as more Americans gain access to medical services and treatments. Healthcare expansion typically leads to growth in healthcare and biotech sectors, as companies take advantage of larger markets and government contracts. We might see a positive impact on stocks like United Health Group, Pfizer, and CVS Health, which could gain from increased demand for healthcare services. Now, corporate tax increases. One area where markets might react negatively is corporate tax increases. Harris has voiced support for raising corporate tax rates, especially for larger corporations. If implemented, higher corporate taxes could impact profit margins and create downward pressure on stocks, especially in capital-intensive industries like tech, finance, and industrials. The Tax Foundation reports that higher corporate taxes could reduce corporate earnings, which in turn affects stock prices and dividends. This would likely create short-term volatility, as investors react to potential profit reductions. Large-cap tech stocks like Apple, Amazon, and Microsoft, which rely on high profit margins, might see the greatest impact. Now, on to technology and regulation. Harris policies could also include increased regulation on tech companies, especially around issues like data privacy and antitrust measures. As the tech sector continues to grow, more regulation could lead to added compliance costs and operational restrictions for major tech firms, creating headwinds for companies like Facebook, Google, and Amazon. Greater regulatory scrutiny could impact large-cap tech stocks, which rely heavily on data-driven advertising models and vast networks of customer information. New privacy regulations or antitrust actions could reduce profitability, making tech stocks more volatile under a Harris administration. To summarize, here's what we might expect if Harris were elected. Positive impact on clean energy and healthcare. With policy support, green energy and healthcare sectors could see strong growth, benefiting companies in solar, wind, biotech, and pharmaceuticals. Negative impact on large-cap tech and finance. Corporate tax increases and regulatory changes could create challenges for tech and finance sectors, potentially impacting profit margins and leading to short-term volatility. Ultimately, a Harris administration could drive significant sectoral shifts. Investors focusing on green energy and healthcare may find strong growth potential, while those in traditional sectors should prepare for possible headwinds. Now, let's move on to Donald Trump's policies. Known for his pro-business stance, Trump's policies might boost certain sectors, but also bring specific risks. Particularly, his policies on tax cuts, deregulation, and trade policies may significantly impact the stock market. First up is corporate tax cuts. Trump has historically supported lowering corporate tax rates to boost business growth. If he reintroduces additional tax cuts or maintains a low corporate tax rate, companies across the board could see higher after-tax earnings, which tends to positively impact stock prices, especially in sectors like finance, industrials, and consumer goods. According to the Tax Foundation, Trump's 2017 corporate tax cuts contributed to a significant boost in corporate profits, which fueled a strong market rally. Major beneficiaries of corporate tax cuts include large-cap companies like Apple, Caterpillar, and Bank of America, as lower taxes improve profit margins and cash flow, supporting higher valuations. Another core component of Trump's policy agenda is deregulation. During his previous term, Trump rolled back regulations in sectors like energy, finance, and manufacturing. If re-elected, Trump would likely continue reducing regulations, especially in traditional energy and industrial sectors. Reduced compliance costs could boost profits in industries like oil, gas, and banking. Energy stocks and financials tend to benefit from deregulation, as it cuts operational costs and increases business flexibility. Companies like ExxonMobil, Chevron, and J.P. Morgan Chase might see added profitability if regulations are further rolled back. Next, traditional energy-focused Trump has been vocal about supporting traditional energy sectors, particularly oil, gas, and coal. His policies focus on energy independence and job creation in these industries, which could lead to favorable conditions for energy stocks. A focus on traditional energy could contrast with policies prioritizing green energy, directing more investment toward fossil fuels. Reports from the U.S. Energy Information Administration indicate that policies supportive of fossil fuels tend to benefit companies like Occidental Petroleum, Halliburton, and ConocoPhillips. Historically, the energy sector saw gains during Trump's first term, particularly in response to lowered regulations and expanded drilling opportunities. Next, trade policies and tariffs. One of Trump's most controversial policies is his America First trade stance. During his first term, he imposed tariffs on imports, particularly from China, to support U.S. manufacturing and reduce the trade deficit. If re-elected, Trump would likely continue pursuing tariffs and renegotiating trade deals, which could benefit domestic manufacturing stocks, but create volatility in tech and consumer sectors reliant on global supply chains. Trade tensions tend to introduce market uncertainty, especially for companies with global supply chains like Apple and Nike. On the other hand, U.S. Steel and General Electric might benefit from increased demand for American-made products, especially if tariffs make imports more expensive. Finally, infrastructure. Trump has also expressed interest in increasing infrastructure spending and supporting defense budgets, which could create opportunities for companies in construction, transportation, and defense. Infrastructure-focused companies might see an uptick in demand for materials, while defense contractors could gain from stable or increased government contracts. Infrastructure investment can drive growth in construction and materials sectors, benefiting companies like Caterpillar, Vulcan Materials, and Raytheon in the defense sector. These policies would support industries that align with Trump's America First stance. To sum it up, here's what a Trump re-election might mean for the stock market. 1. Positive impact on traditional energy, finance, and manufacturing. With tax cuts, deregulation, and a focus on energy independence, these sectors may benefit the most from Trump's policies. 2. Volatility in tech and consumer sectors due to trade policies. Trade tensions could affect companies dependent on international supply chains, increasing uncertainty for tech and consumer sectors. Overall, a Trump administration would likely favor pro-business and pro-domestic industry policies, boosting traditional sectors while potentially creating volatility in global-facing industries. To wrap it up, historical data shows that the market generally reacts slightly positively both 1 month and 6 months after the election day. Of course, it also depends on economic conditions and policy direction. If Kamala Harris wins, expect positive gains in clean energy, healthcare, and tech, but possible pressure on finance and traditional sectors due to tax and regulatory concerns. If Donald Trump wins, sectors like traditional energy and manufacturing could see gains, with possible short-term volatility from trade policies. Okay, what's your take on how this election would impact the market? Let us know in the comments. And if you like more content of our analysis, please like, subscribe, and hit the notification bell for more market insights. That will keep this channel going. Thanks for watching.